It's October 2008. The S&P 500 just cratered. Two friends, Maya and Ben, both 28, sit in a coffee shop watching the market ticker on Ben's phone. Maya has $50,000 saved, enough to buy a small house in her town and a decent job. Ben has the same $50,000. They make a bet. If the government bails out the banks and prints money to stabilize the economy, Maya will invest her savings into the battered market right away. If the government refuses to borrow, balance its books no matter what, and lets markets clear, Ben will keep his cash under the mattress until the dust settles. Fast forward, by 2024, Maya's portfolio is worth about $210,000. Ben's cash, after a decade and a half of missed recoveries and higher immediate taxes in the no-debt world, is worth what it was minus inflation, roughly $35,000 in real terms. Why did Maya turn $50,000 into over $200,000 while Ben lost purchasing power? At first glance, it looks like a simple buy low versus stay out story. But the deeper reason traces back to one big policy choice: whether America borrows when it needs to. We're about to walk through an alternate history, one where the United States refuses to run deficits and avoids national debt altogether, and one, the real history, where borrowing became a tool, sometimes messy, sometimes essential. The real question isn't just whether debt is good or bad. It's how the existence of public debt changes interest rates, federal responses to crises, economic growth, inflation, and ultimately the returns available to everyday investors like Maya and Ben. There's a mechanism most commentators skip. Debt is not merely an accounting liability on a balance sheet. It's a policy lever that smooths deep shocks, funds investments that raise long-term output, and changes the expected path of taxes and budgets. And those changes ripple directly into asset prices and personal wealth. We'll test this with numbers you can check: stimulus amounts, unemployment spikes, debt-to-GDP ratios, and portfolio outcomes for our two friends. First mechanism: stabilization through deficit spending. In the real timeline, when the 2008 financial crisis hit, Washington borrowed. The Troubled Asset Relief Program, TARP, and subsequent fiscal packages, and then the American Recovery and Reinvestment Act, ARA, of 2009, about $787 billion, mattered. Those interventions helped prevent a Great Depression-style collapse. Unemployment peaked at about 10% in October 2009, instead of remaining on a potentially higher prolonged path. When governments borrow in recessions, they provide aggregate demand, unemployment benefits, infrastructure spending, tax cuts, things people spend quickly. That spending supports corporate cash flow, reduces defaults, and stabilizes banks. Markets hate uncertainty. The presence of a backstop, that the government will act by issuing bonds and spending, reduces the risk premium investors require to hold stocks and corporate bonds. That lowers the cost of capital for companies and supports investment and hiring. For our friends, Maya, who invested in late 2008 and early 2009, bought at or near the low because fiscal and monetary backstops were in place. If the government had refused to borrow at all, imagine the alternative. Congress slashes spending overnight to keep the books balanced, taxes spike to close the gap, or both. Instead of a policy-driven bottom, the economy would have stayed depressed far longer. In that alternate no-debt world, unemployment would likely have stayed higher, perhaps comparable to the early 1930s trajectory, meaning corporate earnings stay subdued and the stock market's recovery would be much weaker or delayed. So Maya gets a big gain because public borrowing created a bridge for the economy. Ben misses that bridge and waits for a hypothetical market bottom that never arrives as quickly. Let's check back with them now. Maya's down payment into equities paid off. But here's where it gets even more interesting. The long-term growth story depends not only on crisis response, but also on how debt finances investment. Second mechanism, borrowing as front-loaded investment. Governments don't only borrow to smooth demand, they borrow to finance projects with returns that exceed interest costs. Think about World War II. The US public debt exploded to about 119% of GDP by 1946 as the nation financed a huge mobilization. That borrowing underwrote shipyards, factories, research, and a workforce retraining that transformed the US economy. The post-war decades then saw rapid productivity growth and rising living standards. Fast forward to the 21st century, between 2000 and 2020, debt to GDP rose from roughly 57% in 2000 to about 127% by 2020 as the government used borrowing during two big crises, the Great Recession and the COVID shock, to keep the economy intact. In the real world, those investments and supports helped preserve a lot of capital, human and physical, that otherwise could have been lost. For Maya, that meant the companies she owned shares in could continue to innovate and hire. For Ben, in the no-debt scenario, higher taxes and cuts would likely reduce public R&D, infrastructure upkeep, and education spending, slowing productivity growth. To illustrate with a concrete study, historians and economists note that the 1940s defense and industrial build-up laid the groundwork for the productivity boom of the 1950s and 60s. Remove that borrowing, and you suppress the very engines that pushed GDP higher in future decades. Here's a named modern example. In 2020, the CARES Act amounted to about $2.2 trillion, roughly 10% of 2019 GDP. It included direct payments, expanded unemployment insurance, and the Paycheck Protection Program. In countries that provided big fiscal backstops, the output losses in 2020 were partly offset, and the rebound in 2021 was stronger. Without that borrowing option, poverty spikes would have been larger, many small businesses would have failed permanently, and the recovery would have been choppier. For Maya, that meant firms she owned equity in not only survived, but retained workers and customers. For Ben, a no-debt policy would have meant higher immediate taxes to pay for emergency spending or severe cuts, both of which depress demand and corporate profitability. That difference compounds over years. Small reductions in GDP growth, say 0.3 to 0.5 percentage points annually, add up to substantial differences in aggregate corporate profits and market capitalization over a decade. A quick pause. Ben is already worse off in the no-debt world on two counts: a slower stabilization after crises and less long-run growth because public investment is constrained. But there's a third, counterintuitive payoff that really magnifies the gap between Maya and Ben. Third mechanism, expectation management. Debt creates a predictable policy cushion that lowers risk premia and interest rates. This is the payoff most people miss. When a government credibly commits to borrow in bad times and steadily manage debt in good times, investors begin to expect that recessions will be met with fiscal support. That expectation reduces required returns on risky assets, equities, and corporate bonds, because future cash flows are perceived as less fragile. Empirically, long-run yields on government bonds fell through the latter half of the 20th century into the 2010s, as the global demand for safe assets rose and inflation stabilized. Remember the high nominal rates of the early 1980s. The 10-year Treasury yield peaked near 15% in 1981, versus the sub-1% 10-year yield in 2020. When yields are lower, discount rates fall, and present values of future earnings rise. That's a multi-decade tailwind for equity returns. In a no-debt America that refuses to issue bonds, the whole safe asset structure shifts. Where would risk-free returns come from? Government's borrowing creates a benchmark. Markets price corporate risk relative to it. Remove that benchmark, and either the risk-free rate could become anomalously low because of forced savings, or governments could have to raise taxes so much in bad times that investors demand higher risk premia to compensate. Either way, equity valuations and returns could be substantially lower. Let's put numbers to Maya and Ben's portfolios. Maya invests her $50,000 across 2009 and 2010 into a diversified mix that tracks the market. The S&P 500 bottomed in March 2009 and returned roughly 400% cumulative from that low through 2023. For someone who held through the whole period, big swing, yes, but plausible given the 2009-2023 bull run. If Maya bought in stages and reinvested dividends, her $50,000 could reasonably grow to something in the ballpark of $200,000 to $250,000 by 2024. Ben, in the no-debt world, keeps the $50,000 in cash, facing higher taxes and slower wage growth through the 2010s. Inflation averaged around 2% per year in the 2010s. Without real returns to offset that, 5 to 10 years of subpar growth could erode that $50,000 into the low 30,000s in real terms. On top of that, if higher immediate taxes reduced Ben's take-home income, he couldn't add to his savings as much as Maya could. By the time the market finally recovers in the no-debt scenario, if it does, Ben is playing catch-up with a much smaller base. Now the final accounting. Maya's path, $50,000 invested at the 2009 low, compounded by the real-world multi-year bull market and partial reinvestments, ends up near $210,000 by 2024 in our hypothetical. Ben's path, $50,000 held in cash through a decade of lower productivity and higher taxes in the no-debt America, loses purchasing power to inflation and missed returns, ending up in real terms around $35,000 to $40,000. Those are illustrative numbers, but they demonstrate the order of magnitude. The presence of public borrowing as a stabilizer and engine of investment can be the difference between growing wealth several-fold and seeing it shrink in real terms. So what should you, the viewer, take away from this thought experiment? First, don't reduce the national debt question to a morality tale about frugality. The practical question is about choices and trade-offs. Public borrowing can be a blunt but effective tool. It stabilizes economies in severe downturns, funds one-off investments with long-term payoffs, and creates the safe asset that markets price against. Second, as an individual investor, your advantage is time and participation. Maya benefited not because she blindly cheered debt, but because she recognized that policy would likely stabilize markets, lowered her fear, and bought assets when prices embedded a lot of pessimism. Ben's caution in a no-debt world sounds conservative, but it traded away the long-term upside of risk assets for the short-term comfort of cash. And when policy constraints change the expected path of growth, that comfort can become a real cost. If you're wondering what you should do with your own savings, think like Maya without taking this as advice. Build a plan that assumes both possibilities: crises that prompt policy responses and moments where markets misprice risk. Maintain an emergency stash, enough to cover 3 to 6 months of essentials, so you're not forced to sell into a downturn. If you have a long horizon, consider committing a portion of your savings to a diversified investment strategy that can capture recoveries, because history shows policy-driven recoveries often create large gains for those who participate. Finally, be humble about absolutes. The safety of no public debt is an illusion if it means longer, deeper recessions or much higher taxes in bad times. Conversely, unchecked borrowing has real costs. The sweet spot many economists point to is a policy framework that uses debt strategically. Borrow in crises and for high-return investments, and stabilize debt in the good years so the burden doesn't explode. Maya and Ben's story is not a vote for limitless borrowing. It's a reminder that the existence of a fiscal backstop shaped the last few decades of growth, and that individual decisions about investing, saving, and risk can look very different depending on whether that backstop is present. If America never went into debt, the fiscal backstop that smoothed crises and enabled decades of investment would be gone, meaning either harsher recessions, much higher taxes, or a very different economy where people save and invest far more conservatively. If you found this useful, subscribe to What If Finance, new video every week.